Where specifically in defensives, and how does this $13 trillion of negative debt inform your asset allocation?
Well, first of all, we still like equities because we do think that there's more room to run, particularly in the U.S., and so our favorite positions are in the U.S. Within that, though, as I mentioned, we're going to be more defensively positioned. So we're looking for certain sectors of growth like healthcare, but we're also looking at things like REITs and utilities where we think there's good valuation and you could have some interest rate sensitivity. But one of the things we also have to keep in mind that part of the reason why U.S. Treasuries are so low is because that is that $13 trillion of negative interest rate debt. And so investors globally are looking for sources of income, and U.S. Treasuries still look attractive.
Growth versus value. Where are you? I mean, everybody says the value is coming back.
Yeah.
We've got a chart here that shows it's not coming back yet. Is it going to?
Well, certainly in the short term, growth seems to have momentum on its side. But we do think that value has been so out of favor for so long that for investors to have a bit of a longer term time horizon, now might be a good time to start adding to those positions.
But it's expensive. Specifically,
well,
like
it depends.
You mentioned REIT and utilities, so that's pricey.
Yeah.
So how much are you willing to pay up?
Well, it depends on where you are in value, because there are other places like financials where it's actually not that expensive. And in fact, most recently, you've seen some of those stocks underperform. And so there may be some attractive entry points for certain financials here.
But this is the exquisite problem, I think, for an investor. There's a reason why they're cheap right now.
Totally right.
When you've got the Fed saying we're going to cut, everybody around the world going to cut, banks don't look quite as attractive, right?
Well, that's absolutely true. And across the board, we're still underweight financials in our active portfolios. But we are looking for opportunities where we think that there's been a lot of cost cutting. There's some regulatory pressures that are going away. And at these prices, there are select places where we think there's opportunity.
What's your view as we head into earnings season in terms of the potential downward revisions? Because it seems like the story was we troughed in the first quarter, which puts a lot of pressure on the back half earnings to deliver. Do you think we see it?
We think we will, especially in the U.S. What we've seen is a pattern globally where the U.S. earnings have held up better than other places like emerging markets, for example. And one of the things that you're rightly saying is this rally cannot really continue unless we do get earnings follow through, because we've had so much of it has been on the back of re-rating. But we do think U.S. earnings are poised to do quite well in Q2.
Next Thursday and Friday over in Osaka, we have the G20 and President Xi's meeting with President Trump. What's the over and under when it comes to equities and what comes out of those meetings?
Yeah, look, as long as there's not a lot more negative news, we think that will be constructive, because we saw this even earlier in the spring, right? There was a deal, there was a deal, there was a deal, there was no deal, and then all of a sudden equities took a header. And the minute people started to feel like, the Fed was stepping in and there was some opportunity for compromise and an incentive on both sides to compromise, we started to see the rally. So as long as they don't do something dramatically negative, we think we have follow through here.
So where does that leave the dollar? Because Jeff Gundlach tweeted that, what is it, the make or break moment of truth.
Moment of
That's
truth,
right.
Yeah.
Do you feel like the dollar has peaked?
So we've felt that the dollar was somewhat overvalued for a while, and yet it has persisted. And again, I think that's because of the fact that you've seen so much weakness still outside the U.S. So even against a more dovish Fed backdrop, when you have other bankers, being more dovish as well, and you don't see a lot of growth outside the U.S., it's just hard to make the argument that the dollar's weakened significantly in the short term.
Well, as you say, the rest of the world is racing to get ahead of us, and cutting, basically, as it were. Is there no zero bound? I mean, obviously, we've gone past the zero bound. We're
certainly, yeah.
But how
Draghi's talking about going further.
Go?
Right, and in the ECB, they're talking about further south still and maybe buying more bonds. So there still are lots of tools available. And here in the U.S., we've got the luxury, because the Fed did raise rates so many times, that they can actually implement a rate cut or two without it being, taking away all their bullets, so to speak.
So if that's the net, well, how does that stack up for multinationals versus small caps? Because small caps obviously getting a nice bid the last couple of days, but really multinationals have been outperforming despite the dollar hanging in there. So do you have to rethink that, or can they continue?
I think there are a couple of things happening here. First of all, again, global growth generally still okay, U.S. better. Even a lot of these multinationals still have a lot of exposure to the U.S., so they're benefiting from that. Certainly, you've got also that they tend to be a little bit more resilient in terms of having access to capital, lower debt costs is really going to benefit them as well. And you're seeing share buybacks, so that's been supportive for the market as well. So a number of things we think still lift multinational, primarily U.S.-based companies.
Well, what about U.S. versus the rest of the world? Because in that interview with Rich Clarida that was done this morning on Bloomberg, one of the things he said was, look, at whatever problems we may have or uncertainties, we're so much better off than the rest of the world when it comes to employment, when it comes to consumer situation, retail sales, things like that. Is he right?
And again, from a positioning standpoint, we still think the U.S. is the best place to be.